Inflation cooling substantially in June, up just 3% from the previous year, the smallest gain since March of 2021. But it may not be enough to stop the Fed rate hikes. Although stocks are jumping to that conclusion today, one of my next guests says there is still terror risk in the market. There are reasonable alternatives to stocks. Joining me now is Sandy Villery, partner and portfolio manager at the Villery & Company, and Peter Boockvar, who's chief investment officer at Bleakley Financial Group and a CNBC contributor. Welcome to both of you. Before we talk Tara versus Tina, Peter, what should the Fed be thinking about this inflation report and about those who say, well, is a 3% going to be the low print of the next 6 months that we get?
Well, to your point, it will be just from a comparison base effect standpoint. And I don't think the Fed is going to be totally surprised by this inflation print, since it was only modestly below expectations. And prior to this, they seem to be very committed to raising interest rates again. I think the point that the Fed is trying to basically tell the market here is that if we back off, and this is what basically Tom Barkin said today, if we back off, inflation comes back strong, then we're going to be required to do even more. And I think that's their sort of foot on the neck of inflation that's going to remain there, even though they're not necessarily going to be pressing down much further after just one rate hike. It's interesting, the Fed funds futures did not really blink an eye after the CPI print. Because
it was sort of in line with what we knew was going to happen. But, Peter, I want to focus on that for a second. The idea that if they take their foot, off of these hikes and, inflation's going to come back. Well, why? There's signs that the labor market's cooling. Does anyone expect it to reaccelerate?
Well, not necessarily, but they're afraid that there's still that possibility. It's just the 1970s playbook that they don't want to revisit. And that if they do back off, if they do start to cut interest rates, for example, in response to a rise in the unemployment rate, well, what happens if that does flare up inflation again, and then they're really stuck? I mean, just even now, even today, you have oil prices that are quietly at the highest level since late April, coinciding with the weakness in the dollar. So the Fed needs to be stubborn with their persistence on keeping higher rates for longer. Now, I don't agree that they should hike again, but I think keeping rates higher for longer will be its own form of tightening.
Sandy?
Yeah, no, I agree. The Fed is, I think they've got to ultimately, they're going to raise one more time in July, and then I think that's the 11th and final. And so, you look back to 2022 with the Fed raising so aggressively, and growth stocks just got, absolutely beaten up, down 30%. And in 2023, they've already discounted that rates are probably going to stay, roll over a little bit. We see the 10-year today, and growth is up 35% on the year, with value up 2%. So we want to fish in that value pond as opposed to growth, as we think that rates probably aren't going any higher from here.
But isn't that the case for growth? Is that, this has been the pause rally since, I guess you could call it March, maybe the SVB rally, but we've seen this levitation on the idea that the Fed's going to slow down and that supports growth stocks.
I feel like they've already pulled it forward with a 35% return for growth stocks already. And you look at the tech-heavy S&P 500 trading at a multiple over 19 times earnings, and you look at small caps, 13.4 times earnings. So when we're looking at new ideas, we're certainly not looking in the larger cap tech space. We're trying to find things that are more in the smaller cap or value side of the equation, where there's value to be found.
You like Caesars, you like Freeport-McMoRan, Palomar, you like First Hawaiian. A lot of these do have bank names. Are you worried at all about those results as we move through earnings season?
I just think they're not priced for perfection, right? These are names that have been overlooked, and they're undervalued, and so I think they could all do well. Caesars in particular, got beaten up a little bit this year because they've got exposure to the consumer, and they've got exposure to higher interest rates. But I think that it's not going to be that bad for Caesars at all. Tom Reeg's a great CEO, and I think they get through it. Now we're 6% off the all-time high for it, or the 52-week high. So we like Caesars a lot.